This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now as we take a look at the market trade action on Tuesday, a lot of risk-on type trading led by these wheat markets amid more tensions between Russia and Ukraine. Here to tell us about what he saw in the market trade on Tuesday, Jim McCormick with agmarket.net. Jim, good to have you back on the show, sir. How are you?
I'm doing well. Thanks for having me on. I appreciate it.
Jim, thanks for the time. We have a lot to discuss, and as I mentioned, these wheat markets, I think it was close, or maybe it did get it. Chicago wheat, I think the highest close in 2 months, or right around there on Tuesday. Just a lot of concern, a lot of tensions rising again. Not that they've fallen off between Russia and Ukraine. This talk of Russia annexing parts of eastern Ukraine. It just seems like that really spooked the wheat market, and traders really poured some money in there on Tuesday. Talk about what you saw and the issues that we see developing in the Black Sea region.
Well, what's going on, folks, right now, Jesse, is there's 4 separatist regions. At the beginning of the war, they just said they were independent countries, in essence, independent of the Ukraine, but they were not part of Russia. Russia essentially said they acknowledged them there, but like I said, they weren't part of Russia. Well, here, the game plan has changed quite drastically in the last 24 hours. Now, the plan is for those 4 regions, in essence, to vote to become part of Russia. And by all accounts, they're going to stack the vote. Let's be honest. They're going to make sure that vote goes the Russia way. And all of a sudden, those 4 regions are now essentially going to be declared part of the motherland, in essence, part of Russia, which now ratchets up the game, because now that's going to allow Russia or Putin to mobilize Russian troops, in essence, to defend the homeland, which now this gets a little bit more scary also in the fact that Russia has come out and pretty much said they're willing to use nuclear weapons to defend their country. Well, now it gets a little bit gray to the trade, is those 4 regions that were up until Friday were part of technically Ukraine. Now the Russians are going to say they're part of their country. What happens? I mean, remember, when we started giving the Ukrainians long-range weapons, we told them, hey, use them, but do not use them in essentially firing into Russia. So now what happens, the risk I think the market's worried about is now those long-range weapons that technically are going into the separatist region today, which technically by Friday, according to Putin, they'll be going into what is now Russia. And what does that do to the escalation of this war? And plain and simple, that brought the war premium right back into the marketplace. Because remember, they're also trying to get this crop. They're just starting harvest of the corn and the sunflower and these other products, as well as trying to get this winter wheat crop planted. So this is probably not the best time in the world to really ratchet up tensions, as the world is still trying to deal with a relatively tight food situation.
Very true. Well, and Jim, looking at the sharp gains in wheat, it was across the board: Chicago, KC, Minneapolis, and all of it as well in the face of a higher U.S. dollar again on Tuesday, and the Federal Reserve meeting going on this week, which is, I know, a backdrop in these markets really weighed on the outside markets, the stocks and energies. But you mentioned that tight food supply. I mean, the balance sheets for wheat, corn, soybeans, everything is relatively tight. So taking that Ukrainian production away, giving it to Russia, or whatever the case happens, I just can't imagine how detrimental that could be to global food supplies moving forward, to your point. So it feels like to me there's a lot of chance for this wheat market to add more premium as this situation continues on.
Well, exactly, because with the ratcheting up of the tensions, Jesse, now the question is, will the food corridors stay, open? You might remember last week we saw a little bit of a rally late in the week when Putin was meeting with the Turkish president as well with the Chinese president, and the debate was, would they keep those corridors open? Putin's not exactly, he's complaining that not enough food's going to poor countries, it's going to Europe. Now, nothing happened, but with the ratcheting up of these tensions, and we have seen Putin use energy as a weapon by blocking off the flow of energy on the Nord Stream pipelines. So yeah, I mean, it is a legit problem right now. What the world is trying to decipher right now, Jesse, and the trade's trying to decipher, in a way, it's kind of a macro versus a micro type of situation. The micro being the overall supply. U.S. corn supplies, looking at projected ending stocks at 1.2 billion bushels. The old line is small crops get smaller, big crops get bigger. Well, this crop got smaller in August to September. Statistically, it's like 70, 80% chance that it's going to get smaller in October. Well, we've already cut demand by 570 million bushels. So that puts the carryout down to 1.2 billion, which really is essentially at pipeline levels. The bean carryout down to 200 million. It's not, we've been tighter, but it's definitely snugging up a little bit. But then you look at the macro picture, the Fed's raising interest rates. They're not the only ones raising interest rates. There's almost pretty much every central bank around the world is raising interest rates, trying to put this inflationary genie back in the bottle. That's driving up cost of everything, which tends to drive down demand, and hence the reason why they raise interest rates. They're trying to snuff out demand, but it's also going to have potentially have a negative demand, impact on food demand potentially, as maybe people don't go out to eat, or you have to see hog herds liquidated. So it's a very, very volatile situation from day to day. Are they trading the macro front? Or are they trading the micro front? We do need to keep an eye on the US dollar right now, because it's pretty amazing. But right now, the US is the most expensive wheat in the world. We're the most expensive corn in the world, and we're the most expensive beans in the world as we speak today. If the dollar continues to march higher, it will just make us that much less competitive, which could be a problem down the line potentially.
Well, thinking about the macro versus micro factors in the broader grain sector, Jim, a thought that I'd love your thoughts on. Does it feel like maybe the cash markets right now are doing the job of rationing demand as traders wrestle with the macro micro side from a day-to-day basis on the board?
I think you're definitely seeing it have a little impact in certain parts of the country more than others. There's no doubt about it. The elevator system is having a very hard time bridging from the old crop to the new crop. I know parts of Illinois right now, if you can get beans delivered in the next 48 hours, they're going to give you $1.85 premium in Central Illinois for beans. But if you hold off 6 days later, you're getting 15 over the board. So you can see they're just having a very hard time bridging it. So the basis is doing the heavy lifting to try to get the grain to market. And then we'll see what happens. But yeah, I mean, because essentially, traditionally, what I'm worried about, and I think we could have seen more pressure in the market this week if it wasn't for this Russian story, because the funds plowed into the market earlier in the year on the inflationary play. When the Fed started raising interest rates, they chased them all back out of the market. Now you look at it, they're starting to build back a little bit of length, at least in the corn market. With the Fed anticipated to raise rates at least 0.75 of a point tomorrow. Some people think they could shock and awe us by another point. But I think no matter what they do tomorrow, the consensus is we'll be at about a 4% Fed fund rate by the end of the year. And, that's essentially telling the funds there's no reason to be long commodities as they're trying to snuff out this inflation. So it could be an interesting situation. If you're a producer out there, we're going to tell you to, be very flexible on the basis. Because like I said, that may be what does the heavy lifting to try to bring grain to the board, like we're seeing right now in Central Illinois. They're trying to bridge old to new. So it's going to be a very, very volatile season. I would guess, Jesse, just looking at where we're at, the basis is probably going to be a little bit better in the West compared to the East, because that is where we're seeing the shortages, plain and simple.
Jim, on the soybean side, soybeans started out and had Monday trade fairly solid. We saw a solid trade on Tuesday, of course. It feels like there's some good demand under the bean market, under products, meal, a little bit in bean oil. I heard some rumors China might have bought some cargoes off the PNW. As you look at this soy complex as a whole, does it feel like there's a little bit better of a demand story there right now, even amid a tight balance sheet here in the U.S.?
Well, right now, the beans are definitely kind of an interesting situation right now. This is the time of year traditionally we sell a lot of beans. If you look at historically in our export program, we tend to export a lot of beans this time of year. And then as we get into those late winter, spring, we tend to be a little bit more aggressive exporting corn, plain and simple. So we are seeing a little bit better demand on the beans. But what's interesting right now that we're waiting to see how it plays out is what's going on in Argentina. Argentina had a cash crunch, plain and simple. Their inflation is 100% inflation by some accounts. So the producers were refusing to sell grain. The government was running out of cash. Plain and simple, their reserves are down to about $2 billion. They needed a way to generate money to get a loan for the IMF. So they came out with this new soy peso. I'm sure you've mentioned in many over the last couple of weeks. Well, that soy peso has done what it is meant to do. It has brought somewhere between 7.5 and 8 million metric tons of beans onto the market. And their estimates are they're going to sell up to 10 million metric tons of beans, which will give them about $5 billion, which is what the government's trying to do. Now, the real question, Jesse, is let's say they actually do sell 10 million metric tons of beans. Now, traditionally, they're not big bean exporters. They tend to sell meal and oil. So now they're selling the raw product instead of the meal and oil. And the question is, who's going to get shortchanged? So as the Chinese come in and buy 15, 20, 30 cargoes of the Argentina beans, are those 15, 20, 30 cargoes of beans that we would normally be selling to the Chinese and we're going to lose the business? Or is it going to be maybe the Brazilians that lose some of that business? But more than likely, there is going to be some lost business. So that's something we need to be a little bit cautious about on the demand front. So that may limit beans up near $15, at least temporarily on the board. Now, there is one positive note I could say, well, it's going to Argentina. Like I said, they traditionally buy beans, the crushers do, and then make meal and products and sell that on the open market. If they can't get their hands on the beans because they've sold it to the Chinese, maybe that gives an opportunity to our crushers to crush more beans and sell some more beans and bean oil onto the world market. So there is a little bit of positive news to it, but it's something we need to be concerned about potentially lost demand.
Jim McCormick, agmarket.net, our guest today. Jim, one more thought specifically in this corn market. After Tuesday's close on the board, we're pretty much buttoned back up against $7. We're right up there, $6.90 range. What are your thoughts with this corn market? Breaking through maybe some of that quote unquote, psychological resistance or chart resistance here around the $7 mark. I mean, what does the top side look like on the charts to you? What are your thoughts with this corn market if we can bust above $7?
Well, if you can get above $7, I think it does open up the market to make technically to make a big move. Now, I think right now I'm a little bit hesitant to think it's going to break above $7. A lot of that's going to hinge on the wheat. If the wheat market just makes another move back up to the $10, $11, $12 levels like it was at the apex of the fears of the war, all bets are off. But the reality is right now we are going into the gut slot of harvest. I mean, harvest is just starting to pick up. Where I'm at here in northern Illinois, we're just getting ready to start moving some beans. Central Illinois, they're starting to harvest some corn. So harvest is, I think you're going to start seeing some harvest pressure at $7 corn. With the Fed raising interest rate, that might limit the buying a little bit. And then until we get a better handle where this crop is, I do think eventually the odds are high that we're probably going to make a move above $7 corn. Producers, we're telling them, Jesse, take advantage. I mean, if you get a good basis push, do not be afraid to sell some of this corn and then maybe use like a May option strategy to re-own it into the spring, summertime. Because like I said, with that carry out at 1.2 billion, folks, we're pretty much at pipeline levels. So if the demand is understated, I mean, picking out demand this year is very, very challenging. Europe's crop's probably going to get a little bit smaller. That may force more demand here. If the Ukrainian war gets out of hand, they can't export corn. That could be a problem. So the opportunity for demand to be understated is legit, as well as this crop is getting smaller. And then the other thing is just looking at the world balance sheet. It is tightening, and it's tightening despite the fact that they're projecting the world production, not the world production, but South American production in Brazil specifically to rebound to record all-time highs. La Nina is hanging around at this point in time, is all projections. If La Nina hangs around a little bit too longer than anticipated, and their corn crop stumbles in South America, all bets are off about where this corn market can go. Because one last note, fertilizer prices, they've gone through the roof. Mm-hmm. Can we get our hands on the fertilizer? Can we, the odds say that we're going to plant more corn. That's what the producers are telling us. Do we have the fertilizers to plant more corn here in the United States as well as the rest of the world? So, I think the volatility we've seen this summer is not going to go away as we go into the fall. If anything, it's probably going to increase as we go into 2023.
A lot of great things there to consider. I think at the end of the day, Jim, and you can stop me if I'm wrong on this, but risk management, when it comes to your risk manager right now, having options in front of you, as many options on the table for yourself as you can, is probably important just with so much volatility right now in this market.
Well, I think you said it best. I mean, the reality is when you look at the U.S. balance sheet, it's very hard not to get very bullish, in my opinion. Like I said, a 1-2 carryout, crop getting smaller. That's all the reasons the role for a producer to say, put it in the bin, lock it up, and let's wait for $8 corn. But, the reality is the macro front, the inflationary plate, the higher U.S. dollar, China continuing to slow down their economy due to COVID restrictions, as well as the fear of a worldwide recession. Those are all reasons why you need to also take a pragmatic viewpoint and go ahead and lay off some risk. Take advantage of these higher prices, maybe convert to a lower risk option strategy. The other thing we're also encouraging producers to do is take a very serious look about laying off risk on this DEES 23 corn, because there's no doubt about it, Jesse. They're locking in a lot of high fertilizer prices right now. And what I like to remind producers, the market does not guarantee you a profit. It does not have to give you a profit. If we are moving into a recession and all of a sudden demand is cut by 300 million bushels, all of a sudden this 1.2 carryout's now 1.5. There's no reason to have $7 corn if you got a 1.5 carryout. There's no reason to have beans at $15 beans plus if all of a sudden the Chinese need to cut their demand by 20, 30, a chunk. So it's something you need to, we're in a very good point in the fact that you can lock in profits and have it both ways, but it's something we really are encouraging guys to do simply because the risk and the volatility is going to get more and not less.
Jim, livestock markets, cattle, feels like we're kind of chopping around a little bit here in the live cattle trade. I know we have that cattle on feed report coming up Friday, so traders may be a little nervous ahead of that. Feeder cattle, no doubt pressured by higher corn prices on the day Tuesday, but this cattle complex overall feels like we're maybe just continuing to chop around a little bit. Any thoughts in the cattle trade right now?
The cattle trade is kind of caught in a sideways market. We're right back up kind of near the summer highs, but the reality is it's a tug of war. I mean, we're encouraged, by all accounts, the cattle herd is getting smaller. The beef supply is going to tighten as we go into the fourth quarter, into the first quarter. So that has got the buyers kind of a little bit friendly. But the reality is the consumer is being pinched by these higher inflationary costs. Food prices keep going up. Energy's come down a little bit, but the reality is consumer sentiment is definitely moving a little bit negative. And when it turns negative, it tends to hurt the demand for beef. So that's kind of keeping the cattle more of a sideways chop.
Hog market maybe found a little bit of technical support here, maybe settling into a little bit of a range. I know that cash market taking a beating in recent weeks. We've talked about it coming in line with that October contract, but hogs feel like they're just kind of maybe settling into a bit of a range here as well, Jim.
Exactly. I think that's kind of where it's at. I mean, the hog market would like to see some demand, but that's where we talked about this higher currency. That's really kind of causing a problem right now, to the buyers of our products. So, yeah, I would say, unfortunately, the cattle market and both the hog market are more of a sideways move than anything else at the moment.
Jim, any other final thoughts before we let you go here today? Great stuff as always. I know plenty to watch in these markets, but anything else you want to mention to producers before we run out of time?
One other thing I'll just kind of mention, we are out, we're past the September WASDE number, definitely threw some surprise numbers at us. We do have a big report here at the end of the month, the quarterly grain stock report, which has a history of sometimes surprising us right now. Right now the government's saying we got 1,525,000,000 carryout. They're going to tell us how accurate that number is at the end of the month. If for some reason they would find out 150 million bushels are not there for whatever reason, the cash market was relatively strong late in the year. So it wouldn't surprise me if we found out maybe the carryout wasn't as big as we think. That will get tacked. Those lost bushels will just come into the balance sheet, which potentially could just tighten the new crop balance sheet that much more. So, like I said, be prepared for a little bit more volatility as we go into the end of the month.
Well, Jim, if producers need some advice with all the volatility in the markets, I know they can reach out to you and the team there at agmarket.net very easily. What's going to be the best way to get a hold of you guys?
Any of the Ag Market team members can be reached at 844-424-6758 or go to the agmarket.net and sign up for a free trial of our research.
Fantastic. Well, with that, Jim McCormick, agmarket.net. Always a pleasure, sir. Thanks for joining us here today, and we will talk to you again real soon. Thanks so much.
Thank you again for having me on.
Jim McCormick with agmarket.net. That's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.